Hello guys and welcome back to the channel. So today we're going to talk about a very interesting company called Zoom, and this is a Cathy Wood's darling. This stock has been a retail favorite. It's over 81% down. It has a fantastic balance sheet and it begs the question, is it an investment now in this current market environment? And I'm going to do my evaluation on it, my take on it, in the hopes of helping you guys out to make your decisions. This is not investment advice. Hopefully this is educational, and I want to do not a DCF, but I want to show you a way to evaluate stocks that is very simple, pretty much anybody can do. Hopefully it will be useful to you for the future. And if you find this content useful, it would honor me if you would subscribe to the channel so you don't miss any of my new videos. So let's go over to the screen and let's look at Zoom. So this is the stock that we're talking about. They had an IPO in 2019. Now it shows at $66, and then the stock rallied 10x all the way to $600 at the top in the end of 2020, and since then it's 81% down. So a little bit about the company. I mean, I don't think it needs any introduction. They are a video communications company. Fun fact, I used them during the whole pandemic and for a lot of reasons, but I never ended up paying for the software because I always fit into the 40-minute meeting window, or I had two people meetings, which is unlimited. So this is already sort of a red flag for me if I invest in a company that I never ended up buying the product. Somehow I was just always able to surf by on their free thing, and normally I like to invest in companies where I personally buy and I'm very satisfied with the product, and here I'm very satisfied with the product. They just never made me buy it somehow. That's a miss. Currently the stock trades at $111. The company has a market cap of a little over 33 billion. A PE ratio, which is very interesting because in itself the PE ratio doesn't mean anything. It's at 24, which sounds really low for a tech company, but normally the way to look at a PE is in relation to the growth, and then you get what is called a PEG ratio. So what is acceptable for a company, for example, if your PE ratio is 24 and your growth is, okay, an easier way is that let's say you're growing 10%. Then if your P is 10, then you have a PEG ratio of 1. If your P ratio is 20, but you're still growing at 10%, then your PEG ratio is 2. I believe it comes from Peter Lynch that if a stock is at 1 PEG ratio, it's super good. So for example, if Tesla is at a 50p and is growing 50%, it would be a super good deal. Peter Lynch would think that it's expensive if a stock is at a PEG ratio of 2, meaning for example Tesla at 100p with a 50% growth. However, when he said it, the rate environment was very different, and it was before all this money printing. So today it's more like if you're below a 2 PEG for certain industries, especially in tech, that's considered a reasonable price, and anything over that can be considered overpriced. So why am I going into this? Because this company is a very interesting investment case study, because they have an amazing balance sheet, income statement, cash flow statement. If you just look at their growth, so basically if you just look at their growth, you see that in 2017 they went from 151 million to doubling to 300 million, to then doubling to 600 million, to then like 5xing in 2020 to 2.6 billion, to like 70% growth in 2021. So incredible growth. You have incredible profitability, 33.54% profit margin, kind of insane. Then when you go deeper into their financials, you look at their balance sheet, they basically have no debt. So look at this, they have $85 million of long-term debt, and they have 5.4 billion with a B in the bank. So that is a crazy good balance sheet. And if you look at their cash flow statement, then you see that they're generating 1.3 billion in free cash flow, 100 million, 20 million. It's growing insanely. and you can't really find better. So this is their past, right? And when you do a price analysis, you need to go into the future, and this is where the problems begin with Zoom. So basically, here is where the problem starts. So once you start taking away the growth from a growth company, then the P ratio must come down, which also means that the valuation must come down. So even though this company is fantastic, if you look at what the analysts project in the next 5 years, and by the way, in this calculation that I show you, I might upload it somewhere so that you guys can access it also. What's really amazing with this is that you can play with what would happen with the stock price if they grow with an X%, and then what would happen with the price if the P is in a certain range. And it's very nice to play with this. But my main point here is that the projection for the next 5 years in growth is an annual growth of 13.58%. And my god, that is nothing. So here I made a table where I played with 10% revenue growth, and their 2021 total revenue was $4.1 billion, and then I just made it in Excel, so it's 10% every year. And then what's interesting for me, because I'm a longer term investor, is what is the market cap going to be in 2025 and in 2030, and what would that be in share price, and is it a good buy for me? And I'm going to show you a really good way to tell if this stock is a good buy for you. I really hope that you like this. So then I took their EBIT, which is basically their profit, earnings before interest and taxes, and then I did the same to it, that it's growing 10% up to 2030. So, and here is what I basically went into, that if the growth is so low at 10%, and even if you then give a 20p, which would be a 2 PEG ratio, which would put the price like at the high end, right? Then we would get to a market cap of 31 billion in 2025, and we would get to a market cap of 50 billion in 2030. Now, mind you, the current market cap is 33 billion, so that is a downside in the next 5 years, but a very small upside in the next 10 years. As for share price, this would translate to a $104 share price in 5 years from now, and $167 share price in 10 years from now, and the current share price is 112 basically. So as you see, you would be down in 5 years and you would be barely up in 10 years. Now here's the very interesting thing, that I made this calculation, like if you would want an X%, like what is it that you're happy with? I think most investors are happy with the 20% return. Then what would the stock price need to be today so that it's a good buy for you and you do get the 20% on that per year? And obviously you just take the share price, and then you take the 20% times the amount of years that passes, and then that's how you get $50. If the price would be $50 today and they are growing 10% per year, which is the analyst projection, and this is even like a high-end look at the company, because you're giving it a generous P compared to their growth, then it would have to be $50 today if you want the 20% return, or $32 in today if you want the 20% return in 10 years from now. But here's the interesting thing. So before you write off Zoom, because the growth, let's be honest, that is the biggest question mark around this stock, because if I can totally see. By the way, I'm from Sweden and life is completely back to pre-COVID here, and we still have digital meetings. It's not as much as when we had during COVID. So I can totally see that if you bought Zoom during the pandemic, you wouldn't cancel it because there is still a need. However, if you didn't end up buying Zoom, like I didn't end up buying Zoom, I don't know what would need to happen for you to jump the gun now. And this is where I really, really question their growth. But if we just increase their growth to 20%, and then to keep the PEG ratio the same, so we're comparing apples to apples, we raise the P to 40%, wow, we get a share price in 5 years of 2.94, and in 10 years a 31, right? And if you want a 20% return on your money, then the share price would have to be $142 today so that you get the 20%, like, so you get your yearly 20%. So basically, then Zoom would be a buy today. And if the company grows even more, then obviously this number is even more. I can, just for the sake of playing with it, even if we don't increase the PE and we have a PEG of, I don't know, 1.333, you would have a $400 price tag in 2025, and in 2030 you would have a 1,500 share, and even for your 20% return, it's $195 a share. So if you are a current shareholder of Zoom, or you are thinking about buying Zoom, basically what you are betting on is that everybody is misestimating their growth, and they are going to grow. And the thing is, they have been growing 100% per year, so it's not that hard to grow 20% for this company, although I just don't see it. This is my own opinion. I rather invest in Palantir, which is a stock where it's way more secure for me, way better calculation. But I think this is important for you to know, and you can make your own decision. So basically, if you disagree with analysts and you have some inside info, in which case do let me know in the comments. So thank you so much for watching this video. I hope that you liked it, and I will see you in my next one. Bye bye.